there's no way we can put rates up in an indebted world like ours without more pain, without more trauma being introduced to the capital market.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Here in mid-year 2023, the stock market's taking a pause after a surprise run that practically no one saw coming back in January. Will the market strength continue during the second half of this year, or may we have other surprises in store for us? To discuss, we welcome financial advisor Jonathan Wellum back to the program. He's founder and CEO of Rocklinc Investment Partners, Wealthion's first endorsed financial advisory partner in Canada. Jonathan, thank you so much for joining us today.
Great to be with you, Adam. Thank you very much.
All right. First of all, I hope you're doing well up in Canada. Looks like the sun is shining. Hopefully it's not blocked by smoke from your wildfires. I hope you guys are doing okay fire-wise.
Yeah, I think most of the fires now are under control. So I apologize to our American friends who were inundated with some of our smoke. But the reality is actually in Ontario, where I am just outside of Toronto, we've had a lot of rain and it's been unusually cooler, probably about 10 degrees Fahrenheit cooler than normal, and lots of rain. So no concerns with fires here anymore. And so we're glad about that, and our forests are growing, and no problems up here. So hopefully your air is clear, at least from our perspective.
Okay, great. Well, good to hear that. Hopefully it stays that way. All right. Well, Jonathan, look, very happy to have you back on the program here. We've had a lot of really good feedback to your initial appearance a few months back. A lot of our Canadian viewers very happy to finally have the Canadian perspective represented here on the program, but your just overall macro and investment expertise highly appreciated by all viewers so far. So I want to give everybody an update in terms of how you see the world from a macro standpoint, and then an update on how you're managing your portfolio. And I know you're much more company specific in your portfolio management, so maybe you can highlight some of the companies sort of at the top of your interest list right now. So a lot to go through. But let's kick it off with my general question I like to start these discussions with. What's your current assessment of the global economy and financial markets?
Yeah, I mean, I think the best way to summarize it is caution, caution, caution. And so we're being very, very careful in regards to the overall global markets. And there's a lot of pressure. We've seen, as we talked about before, and as many of your interviews have emphasized, the large backup in interest rates is causing concern all the way around, and certainly for us, that as we have to adjust to different cost of capital, and businesses have to make a lot of adjustments. So we're very cautious. When we look around the world, we think that valuations are generally fully valued, in some cases overvalued. I mean, we're finding, we'll talk about this, I'm sure, during the course of the hour, opportunities in individual businesses, but overall the market is not cheap. Interest rates have backed up substantially, and that's putting a lot of pressure on consumers. And then when we look around the world, we also see that there's pressure on currencies in many different areas. There's also problems in China. There's problems, in many of the emerging markets as the interest rates have gone up. It puts a lot of pressure on their currencies also. And so there's not a lot of economic growth. And so we want to be careful, and we want to be very selective in terms of where we're investing. And we want to just continue to get a better handle on what this all means to us when we've had such a dramatic change in interest rates. And our interest rate's going to continue to just edge a little higher. And is something going to get broken again, as we saw earlier this year with the banking situation in the U.S. And so we're just cautious, being very careful, keeping some powder dry, and focusing on specific ideas.
All right. Let me dig into this increase in cost of capital coupled with a slow economic growth environment. So interest rates have increased by hundreds of percent? I haven't even done the math. Could it even be more than that? I mean, we went from basically almost zero to now 5.25, basically, right? In the span of a very short period of time, about a year and a half. So that is a dramatic ramping up in the interest rates, which flows into cost of capital, right? I would say if you're taking out a business loan now versus, March of last year, you're going to pay about twice as much on that debt. So big change in the cost of capital. When we look at the price of financial assets versus a year ago, yeah, we did have a bit of a rough year last year, but a lot of that's been regained here. So, you know, we haven't seen nearly a commensurate cooling off in financial asset valuations versus the increase in cost of capital that we've seen so far, right? And part of this is because it takes a while to flow through the system. I talk a lot about this channel about the lag effect. We've talked a lot recently about how a lot of corporations are still sitting on cheap debt that they took out before the interest rates started. So it's buying them some time, but at some point that debt's going to mature, they're going to have to refinance. And if interest rates haven't come down, then, you know, it's really going to, it's going to materially impact them, right? So I guess my question is sort of like, you talk about the markets being fully valued or maybe being overvalued. When you look through the lens of the cost of capital and the cost of just doing business and how dramatically that's changed over the past year and a half, do we almost need to have mathematically a bigger correction in financial asset prices than we've had so far, provided, of course, that economic growth doesn't pick up?
Well, we would certainly be in that camp. I mean, so I agree with your comments already. Let me we'll flesh out a couple of things here. In terms of the cost of capital, it clearly has gone up for all companies, and companies that have leverage on the balance sheet and a fair bit of debt. And that's, you know, most companies. I mean, you have technology businesses and some that have no debt, so they're cash rich and they're not as impacted as much in terms of the cost of capital and impacting debt. But there's a lot of companies that have significant amount of debts that they're going to continue to be rolling over, you know, this year, next year, and so on. And so we have seen some drawdowns, I should say, in some of the companies. So we have some investments, say, in infrastructure businesses. Well, those are notorious for having high levels of indebtedness. And in those companies that haven't structured it as well as others, and there's been some, then those stocks have actually dropped a fair bit. We've seen up in the Canadian market here, companies like NPI, which is a infrastructure company involved in large, offshore, wind assets and solar assets and so forth. They've got large assets, and they've had to raise more capital to pay for some of these projects that they've been committed to. And if you're raising capital in this environment and you logged on and said you were going to do this a year ago or a year and a half ago, your costs have changed dramatically. And all of a sudden you see these stocks drop 30, 40%. And so there is pressure on certain areas. Dividend paying stocks also are under a certain amount of pressure because people have bought them for the dividend. And usually they have a fair bit of debt on the balance sheet also. You can look at real estate, REITs and things like that. And they've also come under a certain amount of pressure because people say, well, if I can get a 4% dividend, now I can get 4 or 5% actually in short-term treasuries, then I'm going to move my money from treasuries. And so the dividend paying stocks, or stocks that were bought primarily for the dividend and lower growth, those have all come down in value too. So we have seen areas where we're starting to get a drop in value of securities as a result of interest rates coming up and the cost of money. But that's going to be, as you say, a lag effect. That's going to continue to, I think, impact the market and put pressure on companies that have relied on a fair bit of debt on the balance sheet. Not to mention the consumer, which ultimately has to buy these products and services that the companies are offering. And we're seeing increased pressure on the consumer. And that's why I think some of the retail stocks that are doing better are more the discounters and the ones that are offering the better deals, price sensitivity, value, and things like that. So, the cost of capital is something that's very important. When we value businesses, we're always going to discount based upon the cost of capital. And we've put our discount rates up a little bit. I mean, we're usually using high rates anyway, but we've had, in our view, we've put them up a little higher just so we get a bigger margin of safety when we're valuing that cash flow stream and capitalizing that market value and what we're prepared to pay for our companies. So we're getting a little cheaper, we're being a little more parsimonious in what we're prepared to pay for stocks as interest rates go up. And that's the way we have to look at valuations.
Okay. Yeah. And I agree. And from a valuation standpoint, I started my career a zillion years ago as an investment banking analyst on Wall Street, and it did a lot of, kind of two ways you value a company, two popular ways, right? One is on a multiple of earnings base, right? And that's where the PE ratio comes from. And that's a relatively easy calculation to do. The other one is a discounted cash flow model. And that, I spent a lot of late nights building discounted cash flow models, which is basically where you take a company's financial statements that they report, and then you project them out into the future, right? And so you're basically asking yourself, okay, how much money is this company going to earn every year for the next 10 years or so, right? You project it out. So, okay, it's going to earn all this much. And now I have to discount those future earning streams by some amount for the time value of money, right? $1 today is worth more than $1 tomorrow because there's some risk and uncertainty and inflation and just things that make those future dollars worth a little bit less, right? So you have to pick what's called a discount rate to discount those future earning streams by, and usually what you use is a number that's called the weighted average cost of capital, or the WACC, right? And so mathematically, as the WACC goes up, as the cost of capital goes up, the value of that future income stream is going to go down, the net present value of it, because you're discounting it by a higher number, right? So in theory, central banks pull, frantic levers to vault the interest rate up, dramatically increasing the cost of capital. Valuations of stocks should come down because of that dramatically increased change in the cost of capital. Happened a bit last year, but like I said, we've, at least on the indices side of things, we've regained a lot of that this year. Cost of capital hasn't changed here, but the markets have rebounded pretty substantially. So I'm just curious, as an analyst and a capital manager, do you almost feel like mathematically there's more shoes to drop here, or is there a good explanation for why markets are remaining as elevated as they are, given the rise in the cost of capital?
Yeah, it's an excellent question. I think from our perch, it's difficult to know if there's a good reason for that. From our perspective as more value investors, we simply look at the values, pump in the numbers, and try to understand the business as much as possible and what the potential of the business is to grow. And if the valuations come out too rich, then we stand down and we'll build some cash, or we'll look for other opportunities. I mean, to me, I haven't been in the business for 33 years now, in my 34th year, and I've seen a lot since 1990, ups and downs, and justifying high price earnings ratios, or justifying very low free cash flow yields. Eventually, gravity always sets in, and it goes back to certain norms. And so we want to be careful, particularly as we're managing hard-earned assets of our clients. We want to protect that capital. And so I don't see a justification for companies trading at 1 to 2% free cash flow yields simply because people think they're going to grow 30 and 40% a year for the next 10 years. We just simply cannot pay for stocks like that. Yes, there's an argument for momentum, and some people will play off momentum and then quickly try to get out. But if you're trying to build a position that you want to own for 3 to 5 years, you really have to be disciplined in terms of what you're prepared to pay, and make adjustments as we go along, so that you're doing real-time adjustments. And so I think the market overall, with price earnings ratios that got into the high 20s on the S&P 500 and are down to whatever, low 20s or something, high teens, those can still come under pressure, partly from valuations, but also partly from a slower growth economy that's going to have to deal with these interest rates. I mean, you've had some great people on in the last couple of weeks talking too about just the size of government and bureaucracies, the fourth turning, and all of these things that are coming down the pipe. And we've just seen a lot of challenges, I think, for the overall economy to grow until we can clean up some of the excesses that are there. So from our perspective, again, we go back to the discipline, stay with the disciplined pricing. Then we just have to look harder for businesses that we think trading at reasonable values and providing those opportunities. And I find it quite interesting that Warren Buffett's sitting on, what is it, $130 billion in cash. And people often laugh at him from time to time, but he always gets the last laugh when you look at what he's done over the last 50, 60 years, 70 years of investing. Discipline will pay off, and sometimes people want to chase things, and I understand that's a strategy, but if you're a value investor, you don't want to chase. You just got to, you got to really double down on your discipline and just look harder for businesses to invest in.
Yeah, and good that you mentioned Buffett, because Buffett's famous for the Buffett indicator, right?
Yes.
Which basically, is kind of a finger to the wind, almost kind of like a PE ratio for the entire market, right? And that got really distorted. As we're talking here, I'm just trying to pull it up here and get a sense for what the latest value is on the Buffett indicator, but it was up at kind of near all-time highs right at the end of 2021. It's corrected a bit, but it still looks like it's about 170%. And the mean is actually the historic mean going back to like the early 70s. It's actually a little bit below 100%. So we're still quite in very overvalued territory by that sort of simple but very time-honored metric. Probably does explain a lot why Buffett's largely sitting on his hands at this point in time. Now, obviously, he's got the issue too of having so much money. His investment opportunities are more limited because he has to be able to find something really big that he can put that money into. But it's a good sign.
And you look at the money he has now at 5% in treasuries, most of that's in treasuries, as he's pointed out. He's making $8 billion a year just off of that cash, which again allows him the privilege of just being careful and being prudent and stepping in when he sees the opportunity. So again, we have to. That's the way money is made. If you chase investments and you overpay substantially, and you're not really good at getting in and out, which is a very difficult thing to do, and something that we don't profess expertise in terms of short-term trading, you overpay and it impacts your long-term returns in a severe way. And so we're, again, just caution people, be careful. You can earn in Canada, United States now, short-term money, you're collecting over 5%. And that's not bad for a portion of your portfolio when you're trying to be cautious and looking for greater, better points of entry into the market.
So again, we'll get more into the specific approach that you use, because I think it's instructive for our viewers here to have a good sense of how you do this. But part of it is the time-honored, you make your money when you buy, right? You're looking to buy a good value company at a low valuation, a good opportunity company at a low valuation, and what you're hoping is over time the market will realize the full potential of the company, bring that price up. And that's really how you're making your gain. It's almost the arbitrage of saying, hey, this is a great asset that's a little undervalued right now.
That's true. And our best performing stock this year, I think we certainly one of our top three anyway, would be Amazon. And so, we're not talking about companies that people don't know very well, but Amazon got hammered last year, really hammered. And it was trading at less than 2 times revenue. And so there's a stock, again, that, we're value investors and we're looking at their revenue, we're looking at the potential free cash flow and a few things. And they had a couple of challenges last year, and that stock got cut in half, and more than half. And it was down to $88. And we were able to go in and we actually added quite a bit of it. And all of our new clients, we put a full load on $88, $90. And that's trading, close to 130 in that range. And so that's a big company where people can get pessimistic. And it's amazing how it can become quite volatile, more volatile than you would ever think, and provide an opportunity and a window to step in on that business. And so, Apple, we were able to buy a fair bit of Apple when it got down to 130-ish, 140 or something like that. And so we're holders at this point. We're not adding anymore. But so we're not talking about companies that are insignificant or way off the radar screen. We do have some smaller, companies that are off the radar, off most people's radar screen. But the volatility in any 12-month period on almost all of these major companies is fairly significant. And there's different entry points at different times that you can step in and just go against the market on a great business.
Okay. Yeah. And both those examples, sounds like you were buying where sentiment was weakening. There's still been a lot of positive sentiment on those stocks over the past couple of years because they're part of the Magnificent Seven, but it's not like you were chasing returns like, oh my gosh, it's gone up 30% this year, we got to jump on this train now. That is, you're shaking your head as I'm saying this, that's not the way to go. I want to tie this to an interview that just came out recently with Bill Gross, who formerly managed just a massive portfolio over at PIMCO. He's been called the Bond King. I think that title's now gone to one or two other people since Bill held it, but he was sort of the original Bond King. And in his interview, he said that he's actually bearish right now on both stocks and bonds. And let's take the stock comment first, because he specifically mentioned the equity risk premium, which is basically the expected return that you think you're going to get by owning stocks over bonds. You want a higher return because there's more risk involved when you're holding equity, right? And he basically said, because yields have come up as much as they have, and you just talked about how, you know, Buffett's getting a really nice fat return just by sitting in cash now. He says that the difference between earning yields on stocks and bond yields, it's not attractive enough to take on the risk of being in equities at this point. He said it's actually at a 2-decade low, which to him suggests that stocks are just too expensive relative to bonds here. Would you agree?
No, I would agree with that overall. I think that's an excellent analysis of valuations that are fairly obvious, I think, to most people, and that's why we are not as big as fans of just buying indexes and actually going into individual businesses and trying to find companies that are trading at better valuations than the overall market averages. So no, I think Bill Gross is exactly right. The differential is really not that large, and people do have to question whether they're getting paid enough for the extra risk that they're taking in equities. And then in terms of bonds, I mean, we've been short, and we're not, in terms of bonds, we've been on the short end, the short duration side for quite some time, because we're not bond kings or bond gurus. We're not.
It's sorry to interrupt. I just want to clarify for folks. When you're saying you've been short, you're on the short end of the duration curve. You're not necessarily short bonds right now.
That's exactly right. Yeah, just for clarification, you have to be careful with the wording. So we've stayed on the duration side very short in terms of just buying 6 months to maybe 2-year bonds for most of our clients. And we've been doing that now for the last 5 years. So it's nothing new recently. And part of that is just we're not going to try to make money off little changes in the yield curve. I mean, there are people that do that, and hats off to them, and I wish them well. For us, we're trying to lock in returns for investors, and so we've been on that short duration side, like short-term bonds, for some time. And at this point, we're starting to look at going out a little bit longer. But again, I agree with Bill Gross's comment. At this point, we're still a little bit nervous about the 10-year bonds. Will interest rates continue to truck up a little bit further? Are these inflation concerns going to stick around for a longer period of time? And so we're being very careful also. So I would share his sentiment on the bonds. We're using them strictly as locking in a return, collecting it, knowing our clients know exactly what they're going to earn when we buy the bonds, and not really moving out on the yield curve and trying to play the interest rates at this point. I think it's still, from our perspective, where we're not, again, bond investors all of the time, and we're looking for conservative returns for our clients, it's not worth it at this point, because we're still just trying to get a handle on government policies and inflation pressures and so on. We're pretty frustrated with the response of governments over the last couple of years. I mean, they printed way too much money. The regulations are crazy. We're not production oriented. If you want to get out of an inflation problem, we have to unleash the private markets to produce more products and services, not tamp them down and put them in regulatory chains, and continue easy money. So and then have an energy transition policy, which is putting the cost of energy up and keeping it high. In Canada, it's even worse, because we've got a federal government that's putting carbon taxes on everything, everywhere, and continually putting carbon taxes. So, our price of energy continues to go up even when it goes down on the world market, because the taxes keep going up. And so things like this, continue to put inflation, which puts a lot of pressure on the central banks to continue lifting rates. And so we're not convinced that we're at the end yet. We think we're getting close, but that in and of itself is going to potentially cause a problem for the consumer. And it looks like these guys want to continue going until there's more gets broken. So all of that to us points: be careful, be cautious, buy quality, keep a little powder dry, and know the companies that you want to buy and at the prices you want to buy them, so that we can be opportunistic for our clients.
Okay. All right. I want to tug for a bit longer on this bond part here. I agree with everything you said there. I think Gross would agree with it too. Just to add a bit of data points here, he mentioned that he thinks that fair value for the U.S. 10-year is 4.5% in terms of the fair value yield he expects there. And on the day that we're talking, it's at about 4.1%. So it still needs to come up a bit to get to what's fair value in Gross's mind. And then he talks about, and this is related to what you just said, he talks about the deficit spending that's going on. You talked about we flooded the world with liquidity during the pandemic. We did. We have, ended a lot of those emergency measures, not all. Right? We here in the States, there's a good amount of spending this year being done through the Inflation Reduction Act, which was passed a year plus ago, but is now actually finally dispersing funds. But even though we're not passing new fiscal stimulus, we are in a sense still doing a fair amount of fiscal stimulus, because we're running one of the worst deficits we've ever run before, both in terms of its absolute number, but certainly in terms of a percent of GDP, right? So Gross specifically cites the deficit and saying, hey, that's actually going to push yields higher because we're continuing to borrow to fund that deficit, right? So he's got those worries. I guess let me take a pause there and see if you have any reaction to that, and then I'll continue.
I think Gross is 100%. He's dead on. The deficit in the U.S. is massive. It's massive, and that is the most important economy in the world. It's the reserve currency of the world, and so the pressure to putting interest rates up, I think, will continue. We saw the bond issuance that went on just a couple of weeks ago, and it was so large, and rates immediately started ticking up because people are not prepared to. That quantity requires lower prices to be able to absorb it into the marketplace. And if Mr. Powell isn't going to buy it from the Fed, and it actually has to go into a real market, then yields are going to be pushed up. In Canada, we had massive money printing through COVID too, but or I should say massive deficits. We ran deficits that were even worse than the United States as a percentage of our GDP, and the Bank of Canada absorbed all of that. It didn't even go onto the market. So if we're putting this stuff on the market and we're trying to actually raise the capital to pay for these deficits and putting the bonds on the market, then interest rates are going to be under more pressure to go up, absolutely. And the government spending is completely out of control right around most of the world, not just the Western world, but even over in China now, we've seen problems financially there. And the rates going up are going to have to cause a mishap. And I'm not sure what that's going to be, but there's no way we can put rates up in an indebted world like ours without more pain, without more trauma being introduced to the capital markets. That's our view, and so we're just being very careful about it. So I agree with all of that. The U.S. is still about 1.6 trillion last I looked, and who knows if you can even trust some of those numbers. The unfunded liabilities, doesn't even include the growth in the unfunded liabilities that the government has also, which are multiples of the current amount of debt that's owed, 32 trillion plus. So these are big numbers, and I think that's why when you've had these massive increase in interest rates, people should not get complacent. Do not be complacent. Be careful about this. The inflation is just hurting a lot of people. I saw your latest update that you did in terms of the country singer, the famous that song that's going around, and I cannot agree more with that person's sentiments. But that's policy driven. That's all largely been policy driven, and I think people are just fed up with policies that are not supporting a free market and discipline and long-term capital allocation that makes sense. And so we're going to pay for that. So long and short of that is, I think the increased pressure on rates for the time being is going to probably stay. And that's going to be something that we want to take advantage of as stock investors.
Okay, so let's talk about that. Thanks. This is getting really interesting, Jonathan. So if yields are going to continue going up, and I do want to mark too that, I was talking with people in I don't know, a year ago, right? When Powell had started rising rates, and I had a number of people on this channel saying, "Oh my God, he'll never get above 3%," right? Like the economy won't be able to take it. The populace won't be able to take it. Everybody was screaming at him to pivot, which many were for a long time. And Powell will never make it past 3%. Well, here we are at 5.5%, and Powell is stuck to his higher for longer guns. The market has been always expecting the Fed to pivot, and it's the market's always had to be the one to shift its expectations. Oh, I guess Powell's actually committed to this. Okay, now we're going to expect rates. They were expecting the market was expecting the Fed to pivot in the first quarter of this year, at the beginning of the year, and it's had to keep just pushing it back, right? So first, I do want to say that it's been interesting to see how fixated the world has been on the Fed pivot. First, they thought it was going to happen way sooner, that Powell could just never get things where they are. And then every quarter, every month, they've been saying, okay, it's going to come soon, come soon. I think the market's now beginning to kind of lose the dream and saying, okay, it's probably going to happen at some point in 2024, right? So for many reasons that we've discussed, and Bill Gross is throwing his hat in the ring here, saying, I think yields are going to continue going higher because of this higher for longer policy. I hear you saying, as many do, hey, at some point, because of the lag effect and whatever, we haven't seen the full impact of this. And as the lag effect really begins to arrive in full force, things are going to start breaking. Corporations are going to start stumbling under the cost of capital. The consumer is going to start stumbling because their own cost of capital has gone up, in many cases, even more dramatically, because consumers get charged much higher rates on debt. I think the average credit card APR right now is like 21%, record high, right? So we have this moment that we've got to navigate, which is, okay, yields are going to go up. As an investor, yields are going to go, likely to go up still on bonds. Well, we can play it safe and be on the shorter end of the curve, like you said, and we can just sit in safety and get paid for it. Nothing wrong with that strategy. First time we've been able to do that for a very long time. But if things start breaking, then at some point the Fed highly likely is going to have to pivot, right? And we can talk about when that's going to be, later this year, next year, 2025, whatever, right? But at some point, the Fed is going to have to pivot. One, just because they've either killed inflation and they got to bring rates down because they want to get the economy growing again, or to your case, things really start breaking and they have to start doing rescue efforts by bringing the cost of capital down. That's when being out longer on the duration curve in bonds is really attractive, because that's where the price appreciation is going to happen. So how are you as a capital manager going to make the decision when it's time to start extending out further in duration on the bond curve?
Yeah, great question. So we were talking about this a lot internally, and I think let me point out, we're not trying to tick the very top. We're trying to be approximately right rather than precisely wrong, as the old expression goes in our business. And so when we start to see truly some pressure coming in on the businesses, earnings coming off, not growing as quickly, when we start to, there's a few more bankruptcies, things like that, then we'd be prepared to extend the duration. So at that point, I think the interest rate probably will come off a little bit. We won't top, we won't tick the top and get the best price necessarily, but we'll be able to move in with some confidence, because I think the way down would be quite substantial, and we could see rates drop quite a bit. And so there'll be, if we get in on the second or third or even fourth floor and the elevator is going up to 20 floors, that's fine with us. We don't have to be on the bottom floor and get the whole ride. And so we'll just look at the economy, slow down the economy, inflation coming off, and consumers under more and more pressure, and businesses that are consumer discretionary are coming under pressure also. And then we'll make some adjustments to our portfolios at that point in time. And so we'll just be cautious, careful. And when the evidence starts to come in a significant way, then we'll move.
Okay. And let me get your opinion on this, because I've been asking it of a number of folks on this channel recently, which is, I think the market has the mindset that, hey, when the Fed pivots, then happy days are here again, right? We go back to the old days of QE and ZERP, and it's all going to be great, right? And the market narrative is that, yeah, let's have that pivot as soon as we can get it, right? But history shows that when the Fed is forced to pivot, which, correct me if I'm wrong, but I think you think that's probably the more likely version of this, where the Fed's going to have to respond to things breaking. Every time we've had a big hiking cycle like this, pretty much, it's been followed by a recession. And then the Fed is cutting rates into that recession. And the markets don't perform well for the first couple of quarters, because we're kind of in crisis mode at that point in time, and the Fed is taking crisis measures and whatnot. So I guess what I'm saying is it sounds like there's good historical evidence to be cautious of the mindset that says, oh, pivot means higher asset prices instantaneously. It doesn't. Now, some may respond to the news and the development like bonds, right? Because they're highly interest rate sensitive. Okay, rates are coming down. We see a campaign to be even lower rates. Great, let's get that priced in, right? Maybe, I don't know, things like precious metals might also benefit from that. But your general sort of equities are probably not going to be doing that well in that environment. Do you agree, or do you have a different outlook?
I would agree with that. I think that the run up in debt over the last 30, 40 years has been, just unbelievable, off the charts. So our debt to income ratios, our debt to GDP ratios, all of these ratios are at extreme levels. And that's because we have relied upon, every time this is slow down, the central banks come in, lower rates, put a little extra money in the system, flush, get things juiced up, and away we go again. We've done this so many times now over the last 20, 30 years that I just think that that system and that strategy is going to be under much more pressure next time around. And certainly we're not betting on that. We've got to do something with the indebtedness. I mean, it's just massive. I mean, again, in the US, you go back to the government indebtedness there, 32 trillion. I mean, when Donald Trump was running, it was 18, and that seemed high. I mean, that wasn't that many years ago.
That wasn't that many years ago.
So debt is growing exponentially. And so that has to stop. It just cannot continue. I just, Stan Druckenmiller, the hedge fund manager, reputed and excellent money manager, he recommended a book recently, just in the last couple of months, that I picked up, called The Price of Time by Edward Chancellery. And it's an excellent read about the history of interest rates, going back many hundreds of years, and then taking you up to the current situation, right up to really just right up to last year, actually, because the book has just been published in the last few months. And one of the things that is pointed out historically, which I think is very important for people to go back and look at history and look at what actually happens and transpires, is that these periods of time when you have artificially low interest rates and you have a lot of money printing and you have the central banks stepping in to the free market and causing dislocations and capital allocation and pricing and all these things that we've been talking about, there's always some pain, a substantial amount of pain that we're going to have to go through to clean up some of this mess. And so I'm a firm advocate that there's no easy way out of this. We've been taking the easy route for several decades now, since Greenspan, after Paul Volcker sort of cleaned things up a little bit. And we've been running this game here for some time. And so we need to be prepared for more pain and a little bit more pressure, and be more cautious in terms of how we approach the markets. And just because interest rates are going to come down, you're right. I think it'll be because of something breaking. I think it'd be pressure. We saw a little bit of that earlier this year. We got an indication of that. We saw Yellow Transport go down, bankruptcy. We'll see other bankruptcies, I think, hitting the tape. And so if the Fed's dropping, there's going to be pressure on consumer spending, on corporate investments. All of those things are going to come under pressure. And I think that will, provide greater opportunities in the market, but also lower prices.
Okay. Yeah, greater opportunities, lower prices. So as an investor, you're basically thinking, okay, better valuations ahead, So, and you mentioned you're still keeping some capital dry. You're not fully deployed because you think there may be better opportunities to enter at some point here.
There's
Let me ask you this. Go ahead.
there's always opportunities, Adam. There's always opportunities. I think that's what we try our best to focus on, but not trying to be naive that the opportunities, I don't think they're going to be easy ones. I think we're going to have to really work harder and harder and ferret out more and more opportunities to find.
Well, and we're going to get here in just a second, but that's why, so many of the people who come on this channel over the past year and a half have said that, look, active management is going to become much more essential going forward as an investor than it needed to be in the decade leading up to 2021, because there you had all this intervention, which deformed price discovery, and it pushed the value of kind of everything up. So it was pretty easy to make money, right? You could especially on a passive basis, you could just buy the index, you could buy the ETF, and if it dipped, you'd buy more. And that rising tide just helped you out over time. We may not be able to have those same conditions going forward for a whole variety of reasons, and therefore, picking the companies that are going to outperform becomes much more important, but also picking the companies that are going to be least damaged by some of the stuff that you're talking about becomes really, really important. Quick question for you on inflation. So interest rates have, been sent so much higher in the pursuit of central banks to tame the inflation that resulted from the pandemic, or the policies and some of the systemic breakages that happened during the pandemic. The Fed has made a lot of progress in disinflating since last year, right? We went from a high of 9.1% or whatever. We're down at 3.2 right now on the headline CPI. But it did just tick up. It was 3.0 last month or 2 months ago. Last month, the numbers just came in. It's 3.2. We expected this because of the math of base effects. But if you look at that and you look at where the base effect math is likely to go for the next couple of months, and if you look at other indicators that the Fed actually looks at more closely, like core CPI or PCE, those are the remaining sticky, right? And so this is kind of looks like we're going to have to deal with the Pareto principle here, where the first 80% of the move was relatively easy, but the remaining 20% is going to have the majority of the effort to get under control. So I guess first question for you is, how likely do you think the Fed is going to be in taming inflation? And by taming, I mean getting it down to 2%, which has been the Fed's continuously stated goal through all this. Do you think they'll be able to do that before crisis really hits? I guess based from your earlier comments, probably not, or else the Fed wouldn't be intervening. But do you think they're going to get inflation under control here, or maybe we'd be looking at a more secularly higher inflation era going forward from here, as some people suggest? Not everyone, but some.
Yeah, I mean, to me, it's a very tough question to answer, and not to be evasive, but so much is driven by policy decisions, right? And so if we had a situation where our governments, Canada, the United States, we're actually focusing on the best interests of consumers and their constituents, and really wanted to drive inflation down, they would be getting themselves out of a lot of these industries. They would be, lowering regulations. They would be making it easier to get more energy pumped and energy costs down. They'd be careful about increasing taxation, and so we'd have less. More emphasis on producing and on production. And that's not what we're seeing. We're seeing more and more government interference, more and more government trying to, allocate capital into certain industries, which are more expensive. You see the green transition is probably the best example of that. And so you've got all sorts of these policies coming in that I think are obscuring what's going on and making it more difficult for the Fed in terms of what their mandate is. And so normally, as you know, and I think as many people would realize, we should actually be seeing deflation if it wasn't for so much money being put into the system and in the artificial low interest rates, and also the stimulus from the government spending, that we got so much debt overhanging that normally the pressure would be that prices would come down. So I think the natural inclination would be to tame inflation and prices to come down. But it's all these policy decisions that our governments are going through that are continuing to keep the inflation up, increasing frictional costs, supply chain issues. There's more and more money coming out of China. So we're now de-globalizing, which is increasing costs of manufacturing. The energy costs continue to be quite high. We saw policies, in my view, from the Biden administration, which were not wise at all, taking from your reserves, your strategic reserves, in order to get prices down. But that's artificial. It's temporary. It's short term. It's short sighted. You got to be drilling more holes. You have to be getting more oil out of the ground. Same thing here in Canada. I mean, we're one of the most oil-rich countries in the world, and we have a federal government that's trying to do everything it can to completely destroy the oil industry in Canada. And so part of this in predicting inflation, deflation, what's going to happen, is, to me, it's the wild card of incredibly incompetent and inept decisions being made at the government levels and all sorts of our countries, not just picking on one or two, but just around the world. And so I think the Fed and the central banks are dealing with all of that, the monetary stimulus, the deficits, the ongoing spending, all of this, which is keeping the pressure on the inflation side. So in the short run, I think inflation is going to be very difficult to tame because of all these policy decisions and the government interfering in the economy and not getting out of the way. In the longer term, though, I think the pressure will be more deflationary because we've got all this debt and we're going to have to get rid of some of it, and we cannot afford it. And we've got unfunded liabilities, as you probably know, that are multiples of what people really understand is out there. I mean, you're talking, whether it's in the US or Canada, all these promises that governments have made that they've not set aside money for. These are also huge liabilities. And so things that we're concerned about. So in the short run, I think more inflation pressure. Longer term, medium term, I think it'll be more deflation. And we have to be very careful. You had Lacey Hunt on recently, and I mean, I don't know how you could disagree with his analysis. I mean, he's one of the sharpest minds out there. I think what's interfering with his analysis is, again, these policy decisions, regulatory ineptness. I'll give you one example. In Canada, our leader of the opposition party up here, so the Conservative Party, he quotes a number, which I take it as probably being fairly accurate. He says, if you take our Vancouver market, our real estate market, in Vancouver alone, similar in Toronto, the regulatory costs add close to $300,000 for a housing unit to be built in the cities. $300,000, just the regulatory, the jungle that you have to go through. And if we're not going to clean up the government's involvement in so much of our industries and business and simplify, then we're not going to have the kind of production we need to take inflation down in the short run. But overall, I think we will reach a point where the pressure will be just so large, they're going to break something, and we will see a bit of a crisis. And I think that will bring in more deflation.
Okay. As you were talking before you mentioned Lacey, I was thinking of the discussion with Lacey, and I was going to bring it up if you didn't, but I'm glad you did. Yes, he thinks very similarly to you that once we're sort of through the near-term inflationary spurt, then deflation is going to return with a vengeance because of all the debt stuff. So two questions for you. One is, I talked about this in a recent video where I have been wrestling with the question of, hey, where's the recession that everybody predicted in 2023, right? Because it seems so clear to so many, myself included, at the end of 2022 that we were highly likely going to be falling into one for a whole truckload of reasons, and we haven't yet, at least, right? And one of the best explanations for that, relatively simple, is there's just a lot more liquidity still in the system than we realized. And a big thing that's providing that liquidity is this massive deficit spending that's going on right now on the fiscal side by the current administration. And I likened it to, you have the Fed and now the banking system pressing really hard on the brakes the economic brakes, trying to cool off this economy, slow it down. That's what the Fed is trying to do. It's trying to bring demand down to get inflation under control. The banking system is tightening lending standards, not necessarily because it wants to help the Fed, but it's got instability and it just doesn't want to take on any more. So it wants to only be doing the best loans it can going forward, right? But both of those things are jamming the economic brakes pretty hard on the monetary and banking side. The challenge is that the administration is pushing really hard on the gas pedal right now with all this deficit spending. And so they kind of run counter to each other. You sort of mentioned this, that we've got these kind of conflicting policies right now. But I got to imagine that the Fed and the other central banks are feeling exasperated to a certain extent of like, hey, come on, guys, like I'm trying to do my job here and get inflation down by slowing this economy down. But here you are on the fiscal side, really stimulating things. So just curious to get your reaction to that.
I would assume that would be the case. I mean, I think that the central banks have been put under a tremendous amount of pressure. I don't think that they are as independent as they like to suggest that they are.
Hey, I'm sorry to interrupt, but just in your answer, if you can address one of the dangers of keeping your foot on the economic accelerator from a fiscal side is that you exacerbate inflation. Right. So, are the efforts of the central banks getting stymied by this? And maybe it may make the inflation fight last a lot longer than it otherwise would need to.
Yeah, no, I agree 100%. I think that there's no question that's the case. And the impact is being felt by the laboring class and those who don't have as much money in assets and are being, earning an hourly wage. And so the inflation that we've seen over the last say year and a half or so, which has put food prices up, all the things that you need, food pricing, housing prices.
Food, shelter, cars.
I mean, the pinch on these folks is unbelievable. And in Canada, which would be similar to the States, although as we've talked about before, our mortgages come up on a much more regular basis because generally the longest period that you can lock in your rates is 5 years. And there's quite a few people with adjustable and some do a year, 3 years and so on. But what it means is our rates, our mortgages are coming up on a faster pace. And there isn't a day that goes by you don't read the newspaper. Someone had a mortgage of say $2,600 and they have this beautiful home that they purchased 3 years ago in the middle of COVID and prices, interest rates are rock bottom. Now they're getting repriced literally at twice the mortgage payment per month.
Yeah, and so I'm glad you brought this up. I was going to go there. So how are people dealing with it?
Well, some of them are selling. They're having to sell, so we are seeing some prices come off. And some of them they're working night and day to keep the roof over their head. But it means that all these other discretionary items are going to come under pressure. Food prices are up. And so I think, again, there's going to be all the things that matter. And as I said, in Canada, energy costs didn't even go down very much because our prime minister put more carbon taxes on energy, even when the price did go down. And so this is hurting a lot of people, and the pain is only going to get worse in the next little while. And so that's why I think, again, we want to be very careful and cautious. And I think that, the central banks are probably very frustrated because they're trying to do, to align, to get back to their focus of 2% interest and stability in the labor markets and so forth, which hasn't been as big an issue. But at the same time, it's very difficult when you've got governments that are committed to spending money and more money and more money and more money and handing it out. So we see this tension, and it's going to have to get resolved at some point, but it might be forced upon us because it doesn't look like the adults are actually running things at this point in time and making these prudent decisions that they should be.
Yeah, and all right. Well, look, I'm very unfairly, I'm not going to be able to leave you very much time to talk about your investing approach and dive into specific companies, which I'd hope to. But Jonathan, you're Wealthion's endorsed financial advisor there in Canada, so we will have you back on this program regularly. So we will do that. We'll do it on your next appearance. But the reason why we didn't do it is because we tapped into this really rich and I think very important vein here. Let me try to put a bow on this topic here, which is you're clearly not super optimistic about where things are going kind of on the macro sense, right? Economic growth is sluggish and not likely to get much better. We've got policies that we can argue that maybe aren't the right policies for the time, and we have conflicting policies, as we just talked about. So there's kind of this big mess going on right now. The average person's getting increasingly squeezed, as you just shared, with us, and our economies, US and Canada, are still majority driven consumer spending economies. So as goes the consumer, so goes our economic destiny. And as the consumer gets squeezed, well, that weak economic growth we're seeing is probably only likely going to get weaker, right? So it's a pretty grim outlook. Let me ask you this, because you said earlier, and this is not something that's going to resolve in the next couple of months or quarters. We're now talking years, maybe decades. You said, there's just too much debt in the system that's growing too fast. It's growing exponentially, right? The faster that debt grows exponentially, the more that the debt service cost grows exponentially. We're already having issues. Well, we can't balance our own books here in the US. We're running this massive deficit, and a large and growing part of that deficit now is just interest on the national debt, which just crossed $1 trillion annually for the first time, right? So when you talked about the Chancellery's book, The Price of Time, where you said, look, history is full of examples where the debt kind of got out of control. There's really only two ways that you can deal with it. You have to default on the unserviceable debt. And there's two ways to do that. One is you do not pay it. And actually, we're seeing some of that go on right now in China with some big companies that relate to the shadow banking system and the real estate market there. I wanted to get into those with you. I won't be able to. We'll just have to mark that for our next conversation. But you can literally just stop paying it and default that way. Or you can default on it by basically sacrificing your currency. You just print up whatever currency you need to service the debts. And yet, yes, you're paying the debts in a nominal sense, but you're paying it with vastly debased currency. And of course, that has massive destructive effects for everybody else too. And neither way is pain-free, right? If you become a nation that defaults on your debts, there's a lot of bad consequences that come with that. But if you become a nation that just prints to infinity to service your debts, there's really bad consequences there too. Do you have a particular gut feel as to which of those two ways this will resolve? Or do you see a third way that I haven't seen?
No, unfortunately, I don't think there is a third way. There's no.
I'm sorry to interrupt. There is a third way, which is to dramatically increase your economic growth sustainably. But I just don't see that happening.
No, and we've gotten to the point, even if and I think we should always try that the third way, as you've characterized, and that is to be financially prudent and to drive economic growth and to unleash the power of a free market and be properly regulated, but allow people freedom to make economic decisions and unleash tremendous amount of growth and take advantage of the wealth in the Earth's resources. Having said all of that, even with the level of debt we have now, that would be pretty tricky to bring equilibrium to that with the aging population, the demographics, and the social welfare systems that we have put into our economies that are not sustainable. So that's a whole sort of other issue. But you're right. We should always be trying to grow the economy, expand it, increase people's standard of living, raise people up, give them as many opportunities as possible. But I think to answer your specific question, my guess is it goes back to the currency issue, and we lose tremendous currency purchasing power. That's typically what happens when you look at the price of time and you look at history. People lose. You'll have an unusual period of inflation that will make some of that adjustment for us, whether we like it or not. And I suspect that'll be the case. That's why it goes back to our investing. We do have some precious metals, and we do have assets. We're trying to buy in businesses also that are hard assets, businesses that can sustain repricing, if you will, better than other companies. And I think that's part of the economic strategy, investment strategy that investors should be focusing on. How do I protect my purchasing power if it becomes quite unhinged for a period of time?
All right. Unfair for me to ask you this, but in the next 2 minutes, is there anything that you want to say right now about your current portfolio strategy? Any particular companies that you think are worthy of notice, or just decisions that you guys are making, positions you're taking, et cetera, at Rocklinc that you think the viewers should know about?
I think a couple of things, just sort of ending this and putting the bow on it, as you like to say, that although we see many challenges, that does not mean there are not opportunities. And so be very careful with that. So although I have an we have an outlook where we're cautious and we see lots of sort of storm clouds on the horizon, that does not mean we hide. It does not mean we don't try to find opportunities. So what we're trying to do is look at some of those companies for a couple areas very quickly. Again, we mentioned on the last time we talked, I think some of the precious metals areas. Some of these stocks have not done much for some time. Gold, for example, is not trading that far off its high. It's well into the 1900s. It could easily spike higher. And same thing with silver. And again, we buy some of the royalty companies, which are much more predictable cash flow businesses. We've looked at all their quarterly reports just over the last couple of days, in the last week or two. Excellent, doing well, continue to increase cash flow. Businesses are strong, and they'd be even more robust if there's currency issues or problems. We're also looking at some of the companies that have come off because they have a cost of capital issue and they've been put under some pressure. So some of the infrastructure companies, as rates start to settle and not go too far higher, some of those companies can be excellent buys, especially if the management have great balance sheets and access to funds. We own a couple of the Brookfield companies up here. They're based in Canada, but they're global powerhouses. And some of those companies, I think, are trading at very attractive prices. They have tremendous long-term financing in place. And businesses like that can profit from distress in their industry because there'll be other companies with weaker balance sheets and they'll be able to take out assets at better prices. So things like that, that's what we're focusing on. Areas that are under stress, but then buying companies that are better positioned, better managed. And of course, in technology, there's always interesting opportunities there. And we own some of the companies, some of the software companies like Roper, which we think is a great company. Again, no debt, no net debt, and paying lots of free cash flow. You can't really get rid of these people. You need them in your business. Software companies are very high margin businesses, great cash flow vehicles, things like that. So just looking for selective opportunities, and wherever there's pressure, then jumping in and taking advantage of that. So there's always opportunities. I really want to make sure, again, all the listeners hear that. It's just that we want to be careful and not be caught off guard or sidetracked by some of the challenges out there. Keep our focus on the businesses, on the playing field. As Buffett says, don't focus on the score of the game up at the up where they have the score of the game. Focus on the playing field, and if you focus on the playing field, the score will work out just fine over time.
All right, very well said. Okay, we'll wrap things up here. Jonathan, you've done a great job. It's been really fascinating conversation, I think a very important one. Thanks for going through it with me. I think you've done a very good job of explaining for people how a competent financial advisor is thinking, given the highly uncertain and kind of murky outlook ahead from here. And I'll just reiterate, as I always do in this program, that we think that the vast majority of people in general, but certainly given the current environments, should be working under the guidance of a good, seasoned professional financial advisor who can both build a personalized portfolio strategy for them, given the market situation, given the person's unique financial condition, given their personal risk tolerance, their life goals, all that type of stuff. But not just put the strategy together, but actually execute it for them while keeping the client very well informed along the way. And obviously, first thing you need to find there is a good financial advisor who takes into account all the issues that we talked about here, Jonathan. As there aren't that many of them, right? The vast majority of the industry is a bunch of guys that kind of just follow the easy playbook, from 2009 onwards, and just be along the market all the time. Don't sweat it. Market will always take care of you, right? This very well may not be the right opportunity for that type of mindset, and kind of lack of expertise from my point of view. So anyways, if you've got an advisor who's doing that for you, great, stick with them. They definitely are rare and worth their weight in gold. But if you don't, or if you'd like a second opinion from one, maybe you live in Canada and you'd like to talk to Jonathan and his team there at Rocklinc, well, then consider scheduling a free consultation with one of the financial advisors that Wealthion endorses. To do that, just fill out the short form at wealthion.com Only takes a couple of seconds, totally free, no commitment to work with these guys, just a public service they offer to help as many people as possible position prudently today in advance of what might be coming. Folks, if you've enjoyed this conversation with Jonathan, would like to see him on the program more in the future, please do me a favor, voice your support for that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Thank you so much, Jonathan. Really appreciate it. Want to have you back on the channel again with us soon.
Thank you very much, Adam. And I just want to say to the listeners, we've had the privilege of talking to quite a few Wealthion listeners, and we enjoy it. We love them, and contact us anytime. And I'm more than glad to help in any way we can. As I say, no pressure, and we can give you a good analysis of your portfolios. And we certainly welcome the calls.
Thanks, Jonathan. And look, I've heard a lot of good feedback from the Canadian viewers that have talked with you guys. So this partnership's been off to a great start. So glad we were able to get it going this year. Thanks so much for the partnership, and everyone else, thanks so much for watching.